Hello, my friends. Today is August 5th, and this is an emergency market update. Today was such an exciting day in markets, I figured that we needed an emergency update. Now, it looks like we're ending the day at about 3% down for the S&P 500. Not too bad, but honestly, it wasn't always like that. Now, the first thing I do every single day when I wake up is I reach for my phone and I check the markets. And let me tell you, I turned it on this morning. It was not down 3%. Looking at the Nasdaq futures, S&P 500 futures, 4 or 5%, almost 6% for the Nasdaq futures at some point. It was kind of scary, actually, but not anywhere near as scary as a Japanese investor would have felt. Because the big news today wasn't actually in the US, it was in Japan. You had the Nikkei, their major stock market index, down 12%. Now, 12%, that is a legit stock market crash. That is something that should not happen. That is when you should have everyone panic. What we see in the US, not so much. I think it's largely just reverberations of what happened in Japan. Now, as we've been talking about on my Saturday update, a couple really big trades that the market was in has been unwinding the past week. One, of course, is the yen carry trade, and the other is the short vol trade. Now, the yen has been appreciating against the dollar pretty significantly over the past 2 weeks. And on Friday, we had big appreciation, market sold off, and the Nikkei futures were also sharply down lower. Now, it's always hard to know how much leverage is in the system, how much it needs to delever, but it looks like Friday was not enough. Because when the Tokyo markets opened, the yen further appreciated immensely, and of course, as we mentioned, the stock market sold off a lot. Now, in the global markets, everything is connected through the balance sheet of global investors. So what does that mean? So if you are a Japan-based investor, you likely hold a global portfolio of equities, you own Japanese stock, you own US stock, and so forth. And so when your Japanese stocks are imploding, you have losses. And usually you are a levered trader. So that's how it works usually if you are a large institutional investor. So what happens, you have to cut down your positions, you have to delever because there's more volatility in the market. And that means selling a lot of stuff, mostly whatever's liquid. That could be the S&P 500, which is one of the most liquid equity market in the world. It could also mean things like gold, and maybe on the margins, even stuff like crypto. And so again, if you have a stock market crash in Japan, it's going to impact global markets through the portfolio holdings of global investors. Now, the same thing in the US. Remember Friday, even as Japanese investors were asleep, again, you have a lot of US investors investing in Japanese stocks, selling the yen. When they get hit, they also have to deliver, and they also hold a whole bunch of stuff. So what you're seeing right now is just wide-scale deleveraging of a lot of people. And this has a cascading impact because let's say that I'm an investor and I hold a whole bunch of Japanese equities, US equities. When I sell to raise cash because I'm afraid or I need to make margin payments, that act of selling pushes down the prices of financial assets, which of course may reduce the net worth of another investor and force them to sell as well, and then they sell, the price goes down further. You have these deleveraging cycles that are honestly very common throughout finance, throughout history. So this is totally normal. I guess what everyone wants to know is, when does the selling stop? Now, I don't know, and honestly, I'm surprised it continues so much because a lot of these big investors, big brokerage houses, they have pretty tight risk limits. So risk management is super important for any institutional investor. And so after having the big losses through Friday, I would have thought a lot of them have delivered. If not, I'm pretty sure they'd have to get out today. So I don't think there's all that much of delivering from that trade to do. Honestly, If you honestly, you've already sustained such huge losses. I can't imagine a risk manager not cutting down losses by now. Now, that leads me to an update on the other trade we talked about. Now, let's look at the VIX. Now, the VIX was actually another thing that totally scared many market participants. Now, intraday, we saw the VIX surge to as high as 60. Now, that is a really high number. Now, if you zoom out a bit, historically, this only happens when we have tremendous crashes. For example, when we had in March 2020. Now, intraday, VIX sold off a lot from 60 back down to 30, which is more in line with what you would expect for a market that is going up and down 2-3%. Now, that tells me that, again, you have all these guys who are shorting vol, who are selling insurance, collecting pennies in front of a steamroller. Those guys really got squeezed. They really had to cover, and when you cover, of course, you're buying VIX, and that sparks a huge rise in volatility. So, are those guys done delivering? I have no idea, but really, it's hard to imagine someone being able to hold such a large spike in volatility. Again, this is just one segment of the market. You have all these other guys who, let's say, because volatility is higher, they have to adjust their positions. Maybe they're not done delivering. So it's a complicated ecosystem. It's not super clear. That being said, though, now, even though I view fundamentally what's happening in this entire sell-off as just a large-scale deleveraging, which is something we see over and over again, it's also something that I think changes the psychology of the market. And so I think that extends the time frame for us to recover, because we have taken some damage in the markets. So I look at this in a couple ways. Well, first off, again, if you have a lot of people who lost a lot of money, obviously they're going to be a lot more reticent. They're less reluctant to go and go risk on again. And more importantly, their portfolios are much smaller, so they have less assets to go and lever up. It's just a mechanical thing. So the capacity of the market to further climb is hindered when you have these big drawdowns. Secondly, now, the bearish people, to the extent that there are bears that survive the tremendous rally we've had throughout the year, they're going to be looking at opportunities to sell, because from their framework, they'll be thinking that, yeah, you know what, I think the market is going down, bear market, we're all going to implode, buy gold, buy guns, buy stuff like that. So that's one thing as well. Now, the good news is that if you look at these huge surges in volatility, they usually, again, go down slowly. Volatility, historically, if you look at that chart, comes down slowly, and it corresponds with gradual rises in risk assets. Now, to be clear, volatility tends to cluster. So when you're in a volatile regime, you tend to get bigger volatile moves, big up days, big down days, and so forth. It looks like we should get some meaningful bounce simply because we've been down so much. But this volatility takes some time to, I guess, calm down. Now, historically, again, just look at the VIX over the past few decades. It takes time to come down. It usually does, and that usually corresponds to a rise in risk assets, but it takes time. Okay, a couple other things I think are worth noting is that we also got economic data today, and again, it's positive economic data. We got the services PMI. Services is the largest part of the US economy, and services PMI really are quite good, continue to show expansion, and the employment subcomponent also continues to show expansion as well. So the underlying economic conditions of the economy by, again, GDP growth, looking at PMI data and so forth, seem to be okay. Now, the last thing I think is worth noting is how the Fed will respond to this. So first off, if you think there's going to be an emergency rate cut, you need to wake up. That is not going to happen. The Fed does have emergency cuts sometimes. That's usually when the world is really falling apart, like we saw in the pandemic in 2020. 3% drop for the S&P 500 is not an emergency. For context, the S&P 500 is still up around 9% year to date. So I don't see the reason for an emergency cut, and we had some Fed speakers who basically, honestly, downplayed the weakness in the employment report on Friday. My best guess is that we are, of course, embarking upon a rate cutting cycle, and I wrote about why and to what extent in my piece today. But we are at 5.5 interest rates, and there's a lot of room for the Fed to cut, and that's something that we haven't had over the past decade when we were at zero rates. Now, going from 5.5% down to 0 or 3 or 2 or whatever, that is a lot of potential stimulus for the financial markets because it's going to significantly raise the market value of fixed income assets, and that gives investors more net worth and more collateral to pledge to lever up. So I think we are in a very different situation. Again, I don't believe this is the beginning of a bear market or anything like that, but I think the damage today is significant, and it will take time for us to work through. And again, looking through time, there are still many favorable things in the economy and in the stance of monetary policy that are supportive. But again, we're early in the week. Let's see how the rest of the week turns out. I'll be back on Saturday for Markets Weekly. All right, guys, be careful out there.